Good morning. Another record today on more deals. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, one more deal. Tokyo and Washington strike a trade agreement imposing 15% tariffs on Japanese imports. Meanwhile, Tesla prepares to report results following a turbulent quarter for the stock and its CEO, Elon Musk. And Alphabet also in the earnings spotlight today. Shares nearing their longest winning streak ever ahead of those results. A lot of movement in stocks today. Katie, what are you watching?
I'm watching the meme stocks because apparently it's 2021 again. You have the meme era back in full force with stocks like GoPro, Krispy Kreme, and Beyond Meat moving not really on fundamentals this morning. This just seems to be good old-fashioned retail exuberance. Take a look at some of these pre-market numbers, Matt Miller.
Wall Street bets. All right, auto sales also climbing on the auto stocks climbing on the U.S.-Japan trade deal, which sets tariffs at 15%. Japan also agreed to buy 100 Boeing jets, and maybe some U.S. automakers will be able to sell into China. Right now, Stellantis is the only U.S. automaker that has any real sales there. Its shares are up 6.3%. Toyota gaining more than 12%. Huge gains in Subaru as well, for example, today. And then Boeing right now up 1.2%, Katie.
And you can see that enthusiasm in the individual stocks, but also at the index level as well. Markets rallying this morning on that news of a trade deal between the U.S. and Japan. Treasury Secretary Scott Bessent joined Surveillance earlier this morning.
When President Trump tells me what his goals are, I think about what is the best way for me to give good framing to market participants for them to understand what he's doing, because he always has a plan. It's not always obvious.
All right, automakers are surging on that trade deal. For context, Japan exported nearly 1.4 million cars to the U.S. in 2024. The deal comes as Tesla reports earnings after the bell. Bloomberg Global Autos editor Craig Trudell is in London right now. So, Craig, it's mostly the automakers over there that sell cars over here that are doing well, because U.S. automakers don't sell a heck of a lot of cars in Japan.
Yeah, that's right, Matt. And, Trump may want that to change. I think he's going to really have a hard time doing that, right? The Japanese market is very different. K cars, obviously, you don't have any, Fords or Chevys in that segment. The sort of line that you hear out of Japan that, look, it's not so much that we're closed to you, it's that you're not making the cars that our consumers want to buy. There is very much validity to that. And so, any sort of on paper agreement to try and open up that market is really just, kind of window dressing in terms of, this deal that was reached between the U.S. and Japan.
Well, you're seeing the reaction in shares of Stellantis and shares of Toyota. We also showed Tesla up on the board, Craig, which isn't reacting to this news. Of course, earnings after the bell tonight. And we think about the global stance of tariffs. Tesla, at least, has been positioning itself as kind of insulated from all of that noise.
Yeah, I think, in terms of at least relatively speaking, in a better position, the fact that the vehicles that they sell in the U.S. are made there. But this is also a company that has its share of tariff impact. Just last week, reports on the idea that graphite, tariffs for Chinese imports of graphite will go up to 160%. So, even for the relief and certain aspects on the trade front, you also have some real sort of tensions that are ongoing. And, the company did flag last quarter that, on the energy side of their business, the batteries that go into their storage systems that they sell, which has been, a hot business as the car side has struggled, that's really going to be affected by tariffs as well.
All right, Craig, thanks very much. Bloomberg's Craig Trudell covers global autos for us. Let's head back to Washington right now, where Bloomberg's chief political correspondent, Anne-Marie Jordan, has had a slew of high-level interviews this morning. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and now she's standing by with former U.S. Ambassador to Japan, Senator Bill Hagerty. Anne-Marie?
That's right. Senator Bill Hagerty of Tennessee, also the former U.S. ambassador to Japan, so really understands both sides of this negotiation, with the president last night announcing this trade agreement with Japan at a 15% tariff level, reciprocal and for autos. Thank you so much for joining us, Senator.
Certainly. I'm glad to be with you, Anne-Marie, and it is a very big day today.
So when it comes to this trade agreement, what I'm interested in is the politics in Japan, because you really understand that. And Prime Minister Ishiba, there's reports that he may be stepping down. Do you think this deal, I was asking Howard Lutnick this, the Commerce Secretary, do you think this deal could transcend the domestic politics taking place right now in Tokyo?
I think clearly it has. I think this is putting us on a completely new playing field with our allies in Japan. I look forward to what we do with South Korea as well. But if we think about where this is headed, Japan is going to become a major financier of projects that support all of our national security. Our economic security and our national security are aligned. When I was ambassador to Japan, we negotiated 2 trade deals with the Japanese at that point in time. These are not easy to do. And my hat's off to the team, Secretary Bessent, Secretary Lutnick, and Ambassador Greer. They have done a fantastic job and delivered really a terrific deal.
In the President's Truth Social post last night, he talked about Japan opening up for U.S. autos. And we know that Japan has very strict and stringent regulations when it comes to U.S. autos coming in, the safety precautions, as well as agriculture, like maybe rice. These are 2 very politically vulnerable sectors. Do you think we'll actually see that?
Well, I think the Japanese are difficult to negotiate with, but they keep their word once a deal has been made. I know that's not true every place in the world, but the Japanese certainly do. I know the negotiations have been tough. I've been in rice negotiations with the Japanese in the past. It's almost a sacred area in their agricultural sector, but rice has had an incredible run in terms of its price in Japan, creating a lot of inflation and a lot of pain domestically. So I think this is going to be welcomed by the Japanese public to see more rice imported. Will take some of the pressure off of the supply constraints that they have right now in the country.
What do you think this all means in terms of doing a deal with China? The president seems to want to get allies on board before he gets potentially a meeting with Xi Jinping. Do you think having Japan on side is going to help him
Absolutely.
going into even trade negotiations in Stockholm next week?
Certainly. I think it absolutely makes a huge difference with respect to China, because what China can observe is the fact that our allies are working with us. And we're doing this in a way that maximizes economic opportunity here in the United States, makes our nation stronger, and a stronger America means that all of our allies benefit from this. It's a good deal for Japan. Their stock market is up. Our stock market is up. I mean, everybody's loving this.
When it comes to the auto sector, do you now think that, you say the stock market's up, do you now think that even U.S. autos and European autos are starting to look at maybe 15% is going to be the new rate instead of this 25% that is on right now for all the sectoral tariffs?
I think that's a fair assumption. I'm sure that people will jump to that assumption, but they don't know the specifics of the deal. And I think that's going to get down to the hard tax, and we'll see how the negotiations go. I know that Ambassador Greer and Secretaries Bessent and Lutnick have spent a tremendous amount of time on this deal, and every deal is going to be unique. So I think it's going to be hard to superimpose that, but I'm certain that that's where the industry will sort of target now that they see this come out with Japan.
You talk to the White House a lot. Do you think they're going to wrap up all these agreements by August 1st?
Not every single agreement, but the ones that matter. And, Anne-Marie, I think they've been very focused on delivering agreements with those countries with which we have significant trade deficits. And Secretary Bessent sums it up, I think, fairly often, saying there are about 18 countries that really matter. I talk often with Ambassador Greer. He's got term sheets. He's really been working through a very structured, very disciplined process. And I'm very optimistic that they're going to have the terms set. I'm not saying they'll have the final agreements papered, but that the broad terms will be set, sort of a letter of intent style, if you use a business parlance. But that's where I expect us to be.
And just finally, do you plan on going home to Tennessee for a recess this August, or are you going to be sticking around in Washington?
I think that's up to Chuck Schumer. We've had maximum resistance from the Democrat side. They've not allowed a single one of our nominees to go through without putting us through maximum procedural hoops, even though they know the answer. So what that has done is it created a backlog. Every president needs to have their team on the ground and ready to go. I think Chuck Schumer is going to have to ask himself, is he going to continue this resistance movement, kowtowing to the far left like AOC, or is he going to actually stand up and say, look, here's what's good for America, let's get it done. But we're here to, I'm ready to work through the weekend, the recess, whatever it takes to get these appointees done.
If you all do stay, besides getting the president's secretaries and ambassadors through, what else do you plan on working on in August?
Well, an important thing that we never worked on when Chuck Schumer was the leader is putting appropriations bills on the floor. That's happening this week. So we're looking at the September 30th deadline responsibly. We're trying to put our appropriation bills on the floor so we don't wind up with an 11th hour negotiation that winds up, with the government teetering on a shutdown. I don't think we'll shut down, but again, that gets back to Chuck Schumer and the resistance movement.
Do you think potentially we could see a government shutdown if there is a recess and you go home? We should note, though, it's not just Chuck Schumer. Some of your Republican colleagues also want to make sure they have their recess to go talk to constituents.
I think it's important to talk to constituents. I think they elected us. Many of us are in cycle right now. I am myself. But at the same time, we have an obligation and a duty to our constituents to make certain the government is functioning. And this resistance movement that tries to deprive the president of the team that he needs to execute is really harmful to the economy. It's harmful to our national security. So we have to address it. I hope that we'll be able to come to terms with the Democrats. They have not been willing to negotiate so far. Again, as we move on our appropriations bills, I think that really narrows the space that we've got to deal with as we come to the September 30th deadline. So it's all possible to get appointees taken care of. We don't need to shut the government down, but it requires cooperation.
The president gave you a very long shout out last week when it comes to the Genius Act.
Yes.
And I know you're looking forward to the next crypto bill. But there's a lot that's on your plate right now. Are we going to see that before the end of the year, the market structure?
We're working very hard. We just put a discussion draft out this week on market structure. Very proud of my legislation, the Genius Act, that basically opens the door for digital assets in America. If you think about where we are today, Anne-Marie, versus where we were a year ago, it's a sea change. Now the U.S. markets are open to digital currencies. The U.S. markets are going to be open to innovation on the blockchain. I'm really excited about where we're going, and our goal is to have this market structure bill move through expeditiously, get it done this fall.
This fall,
yeah.
So before the end of the year.
That's the goal.
Senator Bill Hagerty, and of course the former ambassador to Japan, thank you so much for joining us this morning. Matt and Katie, of course, he has a very interesting perspective when it comes to this trade deal. He's been at the table with Japan a number of times as the U.S. ambassador, especially when it comes to these very politically vulnerable sectors like autos and rice.
Absolutely. And as a result of that deal being signed, that's why you're seeing some of those sectors rally this morning. A great conversation between Senator Bill Hagerty with our own Anne-Marie Hordern in Washington. We will bring you more from Anne-Marie's interviews with Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick throughout this show. That deal that we were talking about between Japan and the U.S. giving a lift to the broader market as we really enter the heart of earnings season. So let's go there now, because Texas Instrument shares, they're actually plunging right now after its forecast failed to impress due to tariff costs on the business. Bloomberg Tech co-host Caroline Hyde has the details. And Caroline, it's interesting. You actually heard from the company that they're not sure how much of the 16% jump that they saw in revenue was due to tariff-related pull-in. So even on the numbers that are being reported and the look ahead, there's a lot of uncertainty here.
Because this company's posting growth. It's saying, look, revenue, the midpoint in the next quarter is going to be about 11% growth. It was, as you say, 16% growth for their fiscal second quarter. But they said, look, we've got 100,000 customers. We don't know if they did a pull forward, if they stocked up their inventory ahead of the tariffs, or whether or not that was just normal business. They did say, the CEO really articulated that China was running hot. We thought that that might dial back. Remember, that's important when China is about 20% of their overall revenue. So this is a company that is hugely exposed to global tariffs and also has so many customers and a very broad reach of product. This is about analog chips. This is turning sound and audio into electronic signals. And this, therefore, is exposed to every single industry group. So there just wasn't enough clarity, as we saw with NXP yesterday and the plunge that we saw there, because they couldn't signal enough bullishness going forward. Same thing happening at Texas Instruments. If we hold these losses, if we see 10% losses, that's the worst day since about March 2020.
It could wipe out almost all of the gains that they made this year. They're up 15% year to date. They're a $200 billion company, so nothing to sneeze at. But we have a $2.4 trillion company, I should say, with a T, coming out with earnings after the bell. Alphabet, Google. What do you expect?
actually things have got a lot brighter in terms of optimism of this company. As you were saying yesterday on the show, look, 10 straight days of gains for Alphabet could be put on a pause just today, but 10 straight days would be the longest winning streak for Alphabet since 2010. Maybe we could push forward to an 11th day. And the optimism is that, look, for now there is resilience in the search business. For now they can shake off the anxiety around ChatGPT and other generative AI competition and actually be lucrative in this moment. They're managing to pass on costs, make advertising ever more promising, particularly in the YouTube space. Remember, they're dominant in TV now. Yes, there is worry, particularly around antitrust. That's what they've got to shake off, because come August, we get that view from Judge Mehta as to what they have to do to push back on the idea that we're a monopoly in search. Will they have to break apart? Will they have to sell off Chrome? Will they have to start sharing more of their data with competitors? This is the anxiety that has held back, I think, the valuation on the stock. Look, it trades at what, about 18 times future earnings. Now, this is far below its average over the last 10 years and far below other competitors in the space. But we're just starting to see a break positive for year-to-date in performance on the shares.
That's the thing, that even with that winning streak, 10 straight days of gains, it's only higher by about 1.3% year-to-date. So it really tells you about some of the questions that are plaguing this stock. Hopefully going to get some more answers after the bell. That is Caroline Hyde. She is the co-anchor of Bloomberg Tech. You can catch her at 11 a.m. But coming up on Open Interest, Wendy's just joining the 2025 meme stock party, suddenly spiking. Krispy Kreme and Beyond Meat also there as well. So what a meal. We'll take a look at the names that the retail traders can't get enough of next. This is Open Interest.
Let's get now to high interest and look at what's making headlines around the world. AT&T is reporting second quarter results that beat Wall Street estimates, including faster than expected growth in cell phone subscribers. More than 100,000 more than Wall Street expected. And yet the shares are down 3.4% because maybe investors are worried they're not taking advantage of the changes in tax rules enough to gain, like rival Verizon. Hilton is lowering expectations for net income this year as demand for U.S. hotel bookings declined in the second quarter. The CEO said lower government spending, a decline in international travel to the U.S., and broader economic uncertainty are weighing on demand. That makes sense, a down arrow story with a down arrow trade this morning. And Capital One reporting adjusted earnings per share for the second quarter that beat estimates as the firm completed its long-awaited acquisition of Discover Financial Services. That's a good news story, and so the shares are up 5%. Katie?
Yeah, another 5% for Capital One. This is a stock that has been outperforming year to date, so Capital One continuing to rake it in. But let's get to the silly stuff, because meme stock mania is back. Yesterday, it was Kohl's, which spiked over 100% at one point, and Opendoor. Now, fast forward to this morning, we have GoPro, Krispy Kreme, and Wendy's all spiking pre-market. Let's take a look at the action with Bloomberg Equities reporter Alex Semenova. So, okay, what a motley crew of names here. What is the common denominator to the meme stock frenzy that we're seeing right now?
Well, it's that they're all terrible businesses that aren't trading on fundamentals and are all, across Wall Street Bets forums, across Reddit that people are talking about. And it's an effort to get rich quick, to capitalize on these really big swings in these companies. This is stretching into second day today with all of these companies that you mentioned, GoPro, Krispy Kreme, Wendy's, amateur traders piling in once again. This comes, of course, at a time of broader market euphoria with stocks trading at record highs. So it's unsurprising that these animal spirits are kind of moving into more speculative quarters of the market. JP Morgan's trading desk this morning actually flagged that its internal basket of meme stocks is up 7.9% month to date versus the S&P 500, which is up 1.7%. So really a testament to this euphoria that is once again back in markets. And if you look at Kohl's yesterday, that was at the forefront of all of this. It has a float of 48% rather. This is according to data from S3 Partners, meaning that these are, bets against the company. By comparison, GameStop has a float interest of 20%. So really
short
a testament.
interest.
Exactly.
Yeah. Is this exactly like what we were seeing in 2021? I don't remember that far back, but I'm sure you've done the reporting. So what's the difference between now and then?
So the enthusiasm is really similar, but the backdrop in markets is really different. Obviously, at the time in 2021, traders were, their finances were being propped up by stimulus checks. We were at zero interest rates. There was so much enthusiasm in markets. And this time around, there's a lot of uncertainty around the macroeconomic outlook. Interest rates are elevated with the Fed saying they won't cut anytime soon. We have trade uncertainty. So less favorable backdrop for this risk taking, but also interestingly more investment products that cater to this type of enthusiasm. Wall Street's casino has so many options. You have levered ETFs, you have all these companies, you have so many crypto investment options.
I have to say it's wild. I think back to 2021 and what an interesting time it was. But when we would have these conversations, it was all, the conversation was very much, this is a product of ZIRP. This is because we have interest rates at zero, that once we raise rates up, that'll sort of drain all of this out of the market. That obviously has not happened. Yet. The president is screaming for another 3 percentage points to be cut. I know. And that gets us close. It's NERP. Well, that's the thing. You have to wonder, will that just, if we're having this sort of activity when we're at 4.5% or close to it, what happens if we go back down to 1%? I shudder to think. But let's talk about how people, normal people, not retail traders who are sort of jockeying around on Wall Street bets, how do you position around some of the mechanics of what's going on with the meme stocks?
So Barclays head of derivatives, Stefano Pasquale, has actually been flagging this frothiness for the entire summer pretty much. And he says that a way to hedge this euphoria is to use a popular hedge fund strategy called a dispersion trade, where you bet on single stock options and also contracts on broader indexes like the S&P 500. Basically, you're betting that a basket of meme stocks will be more volatile than the S&P 500. But also, alternatively, if you want to take a more directional bet, you can just buy puts on these meme stocks. I don't know if that will pay off quite well given how they're doing. But he also flags one important point is that even though we are seeing this euphoria in these speculative names, it's not necessarily an indication of something nefarious for the broader market.
So buying a put, I guess that would be safer than outright shorting some of these names, theoretically.
Perhaps. Exactly.
Perhaps.
Still seems pretty risky,
seems
given
quite
what
dangerous.
Gabe Plotkin and the rest learned in 2021. Alex, great story, great reporting. Thanks so much for joining us. Alex Semenova there from our BN Equities team. Now, tech stocks are going to lead the way as U.S. equities shrug off tariff risks and get a boost from this round of earnings reports. That's at least according to the MLive Pulse survey, which drew over 100 respondents in a poll conducted earlier this month. For more, we're joined by Bloomberg Markets Today managing editor Christine Aquino. So, Christine, what else did we learn from the survey that I guess favors tech stocks pretty highly?
Yeah, Matt. I mean, there's a lot of faith still in tech stocks leading the way for this earnings season. Very interesting, though, the divergence in expectations when it comes to profit growth for tech versus the rest of the S&P 500. We note that while there's about a 15% profit growth expected out of the Magnificent Seven this earnings season, we're seeing basically no growth for the profit of the S&P 493. And this is still very much the issue, right? That divergence between the Magnificent Seven, which has really taken the bulk of profit growth in the S&P 500, and really in terms of the share gains as well, versus the rest of the S&P 500. We note as well that consumer discretionary is being pinpointed as the most vulnerable sector to tariffs. That's the biggest risk that people see when it comes to earnings outlooks this season. And consumer discretionary stocks, more than a quarter of respondents saying will take the brunt of the pain from tariffs if they ever come to pass.
And really quickly, Christine, before we let you go, what did we learn about how folks are thinking about hedging here? We were just having that conversation a little bit with Alex Semenova.
Yeah, very interesting, Katie. I think there's very little appetite for anyone to change their exposure to the S&P 500. I think that, like we're saying, there's still a lot of froth in markets. There's still a lot of speculation in markets. And you really don't have a lot of willingness from investors to let go of their bets on U.S. equities, even though maybe it's starting to look a little toppy. As we've seen, there's still pockets of speculation. There's still room. And so they're still very much willing to hold on to those bets.
All right, Christine, really appreciate the time. That is Christine Aquino talking about earnings season, and that is what we are firmly in. But you take a look at what futures are doing ahead of the bell. It's all about trade this morning, boosting the S&P 500 by about 0.4%. Big tech lagging that, and the Russell 2000, those small caps, out in front. That's your setup as we count down to that opening bell. Less than 4 minutes to go. We're back at the open up next. This is Open Interest.
All right, we are moments away from the start of trading and what looks set to be another intraday record high on the S&P 500. You can see futures right now at 0.4%, so higher and gaining steam into the bell. The Nasdaq up only 0.1%, which is a little bit puzzling because it's the tech stocks we just heard from NLive that should be leading the way, and we do have obviously Alphabet earnings coming out after the bell. You hear and see the closing bell on the New York Stock Exchange with NIQ, the full view of consumer buying behavior. I didn't look at that up beforehand. And Carlsmed down on the NASDAQ. The important point today is that we have a deal, at least a framework of a deal or a concept and framework of a deal with Japan, and that lowers tariffs to 15% for the import of those goods. And so stocks are rising once again.
Maybe that's why these stocks are rising. Just kidding. These are meme stocks. Let's take a look at them. We're taking a look at GoPro, Krispy Kreme, Beyond Meat, Wendy's, some of the favored retail names of the moment in this meme era as it comes roaring back. I know there's no rhyme or reason necessarily to why we're seeing these moves, certainly no fundamental news coming out on these names, but I do want to point out that Krispy Kreme, Beyond Meat, and Wendy's, those are all food items, Matt Miller, so I don't know, something to chew on.
Yeah. But you can't eat a GoPro, no. I want to point out, as someone
you can film yourself.
Once told Ben Bernanke, or something similar to that. Auto stocks are climbing on the U.S.-Japan trade deal, which sets tariffs at 15%. Japan also agreed to buy 100 Boeing jets and invest $550 billion, at least finance that, and lower tariffs on its auto imports as well. Let's bring in NorthStar Asset Management Chief Investment Officer Nimrit Kang. And Nimrit, I'm kind of wading through some murky details here because we don't know the full picture, but is it enough to make you want to buy stocks?
Matt, the market has rallied very significantly over the last few months based on three major things. One is that the trade war that we got started with the announcement of the Liberation Day, that gets resolved. We get a big stimulus investment back into the U.S. here from the big, beautiful bill, the tax incentives for the corporates. And the third is the inflation and employment picture is such that it allows the Fed to start cutting. Any news that supports any of those three helps the market retain its momentum. And that's what you're seeing. That's what you're seeing today. Another big confirmation that, yes, the trade war is not going to escalate into something more ominous. And that's all a good setup.
I want to talk a little bit about what we're seeing in these meme stocks, as we've been calling them. I'm not going to ask you whether or not you're buying into the hype, but what do you think this says about where we stand in markets, what this says about sentiments? It's kind of puzzling that, okay, you think back to the last really big episode in 2021, we were at 0 interest rates. It's a much different setup right now.
Katie, first of all, I like that they're all the food stocks, can kind of relate to that. But I think you're right. What it does signify is this interest of the retail investor back into the market. You know, it's the animal spirits back into the market. That's what we're seeing. We've seen a lot of buying the dip that's happened with the retail investors, and that's continuing on and manifesting into some of those meme stocks as well now.
In terms of what you do want to buy right now, I mean, what would you invest in, Nimrit, right now?
Yes. So, you know, not all sectors are created equal. I think one of the big things that we see is the growth, and the biggest beneficiary of the artificial intelligence trend is really the technology companies. Now, the benefits from AI are going to be broad-based, felt by lots of different companies in lots of different sectors. One of the things we would say is even when we look at how well S&P has done, not every stock, not all the sectors have benefited equally. So even if you take a look at the industrials, the industrial production has been stuck in a lull over the last several years, really. And so many of those industrial stocks, take transport, rail companies, haven't participated. But if we think there's legs to the investment back here in the US, industrials is a great play for the longer term investor to participate in that reinvestment back into the US here.
Okay, so industrials for the longer term horizon. I want to talk a little bit more about tech and earnings after all, given that we're heading into some pretty big names after the bell, Alphabet and Tesla among them. You think about the reaction function that we're seeing so far. You've had companies coming out missing and being punished, but you're even having companies reporting pretty good numbers and still seeing that negative reaction. So Nimrit, as you're trying to navigate through this season, does that give you pause?
It's always tricky, right, Katie? But I think especially if you look at this earnings season, and again, the run-up that we've seen coming into this earnings season, the market is expecting that the companies are going to beat the earnings, raise guidance, and to the extent we don't get that, we don't get support that there's continued momentum, positive momentum in the business, that's been met with a disappointment. That's what we heard out of Texas Instrument, for example, last night, that the recovery is still very fragile and we're not seeing it to the broad base. So I think that's the expectation that's built in. But again, it's going to depend very much earnings company by company specific. But overall, investors are looking for a bit more positivity than that's already baked into the estimates here.
So do you expect that? I mean, we've had earnings estimates come down. Now they're bouncing back up a little bit. How much do you have to beat by to get your stock bid up?
Yes. Again, it depends, but we are looking for that positive momentum, an inflection positive, more than what's baked in. I'm not sure if there's a number I can give you, but for example, the first quarter earnings, S&P earnings grew 13%. This quarter, we're looking at about 3%. I think companies that can really beat well ahead of that can guide positively to the momentum through the end of the year is good. The tricky part is that, the companies are reporting on a quarter that ended at June. A lot of the news related to the trade deals, related to the stimulus from the budget bill, are going to unfold over the second half, and that cadence is going to look, much more uneven. So we actually think that you're not going to get a big kind of bump up coming out of this earnings season. Rather, this is a time where the market maybe settles down, consolidates, and then going into the second half, we'll probably have some more momentum.
It's a good point that, of course, this earnings season, this reporting period ended at the end of June, and we certainly know a lot has happened since then. Nimrit, great to get some time with you. That is Nimrit Kang. She is NorthStar Asset Management CIO. Let's check in on the stock market right now. We're about 7 minutes into the session. You can see the S&P 500 about 0.4% higher. We are in record territory, and the breadth looks pretty good right now. You have 350 names just about in the green, just about 150 in the red. So a good setup there. You take a look at what's leading. You have NVIDIA up there. That, of course, is a huge company. And as such, that little gain that it's seeing on a percent basis translates into a whole lot of points. Then you have GE, Vernova, Thermo Fisher, Meta Platforms, and Berkshire down there as well. So a good mix of different sectors represented. Take a look at losses, though. We are in earnings season, and that is what you're seeing in Texas Instruments, that punishment that we've been talking about. Texas Instruments down 11.5%. That's your biggest loser. Then you have Microsoft, Broadcom. You go down the list. Alphabet there as well. Alphabet reporting after the bell, so keep an eye on that name. Let's take a look at the sector level and what this breakdown looks like. As we mentioned, good breadth. You have 10 of 11 sectors in the green right now. Healthcare is leading you higher, followed by industrials, which Nimrit Kang likes, utilities, energy. The lone loser right now is communication services, but even that, just 0.1% lower right now, Matt Miller.
Yeah, obviously AT&T not helping out there at all, and I think it's doing exactly the same kind of thing that you saw at Text Instruments, right? They beat expectations. They reaffirmed their guidance. They added more subscribers than had been anticipated, and yet they're being punished because the outlook just wasn't strong enough. It's a very high bar for Alphabet as well, with analysts expecting a strong profit. We'll discuss what that means exactly with the analyst Michael Nathanson of Moffett Nathanson next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls from the analyst action in focus this morning. And first up, Boot Barn getting downgraded over at Jefferies because of its elevated valuation. However, the firm remains confident in the company's fundamentals, shares down 1.5%. Next up, Toll Brothers getting upgraded to a buy over at Seaport Research. The analyst expects that the bad news in the home building sector to lessen, or it will lessen rather, with declining new supply and margin stability. And finally, we end with drug maker Sarepta continuing its downward spiral. Bank of America is adding to a spate of Wall Street downgrades. Sarepta, for its part, said it will temporarily pause its treatment for muscular dystrophy following a request from the FDA. The company, remember, had initially refused to, which then drew backlash. Shares only down 1.3%, which looks pretty tame compared to some of the movement that we've seen in this stock.
Yeah, absolutely. And some of the movers that we're seeing in general in this market. Alphabet earnings have a high bar to hit after the bell today. Investors are bullish, though, on the stock. Shares are on course for a record 11th consecutive session of gains, the stock's longest winning streak ever. Moffett Nathanson senior research analyst Michael Nathanson has a buy rating on Alphabet with the $225 price target. He joins us now. Michael, thanks so much for joining us. I'm just getting a message here from a trader saying chances are you need to more than crush it on a forecast when the S&P is trading at 23 times forward PEs. Is Google going to do that today?
Yeah, I would take the other side of that. And good morning, Matt. This stock trades below the market multiple, right? The market's at 23.5 times. We think Google's at 19.5 times, right? I did not know, and thanks for telling me that it's been so strong the past, 11 days. I didn't realize it was a record. It felt like people were really underweight Google. They were afraid of search results, which are going to be okay or strong, and they're afraid of the court case, which is a month away from being resolved. So I look at this going, the stock has been a laggard for the past year. I don't think the bar is extremely high. I just think, search has to come in as expected, double digits yet again. They have to talk about the innovations they're seeing with their own AI development. And I think that the momentum should continue because it's been such a laggard up to this date, and it's cheap relative to the market. So I take the other side, whatever that trader's telling you.
So are you saying then that sentiment is pretty low when it comes to Google, basically that the bar is so low that their likelihood of actually exceeding it is kind of good here?
Yeah, I would say the 11-day action you talk about is an indication that people had left this one for dead, even though it's a Mag 7. It had been one of the laggards. And I think as people started to think about the second quarter, potentially some of the data points you're getting out of their AI trends, people started to either cover or start getting excited about the second quarter and the second half. So I don't think the bar is high as many other stocks in this market, which trade at double or triple the multiple at this point.
There's a great story on the Bloomberg about Elon Musk raising another $12 billion for XAI, and I know that's a completely different league than a giant like Alphabet. But is the amount of spending that they're going to have to do to stay ahead in this AI race one of the concerns for investors? Are they not doing well enough in this AI race? Is that a concern for investors? What's the problem?
I don't think it's spending because they've been doing this for a long time. They've been investing in their own technology, their own chips, their own data centers for more than a decade. They don't have the catch up on the platform technology side. The worry is that AI-driven search, either through ChatGPT, Grok, Perplexity, even AI overviews, will take share from Google's search monetization, right? So there's a fear, and it's legitimate, that Google's 90% share of search traffic will go down as more people use AI or as new competitors enter the field.
Yeah.
That's legitimate. It's a question of speed, when that happens, and whether or not Alphabet's sleeping at the wheel, which I think they're not now. They've got more aggressive by rolling out some new products.
That's certainly still the narrative that's haunting the stock price, though, that maybe that they've been, as you say, left for dead, sleeping at the wheel, and that's certainly an existential threat that you identified. But I want to talk a little bit about their other bets division. That houses Waymo, and certainly robo-taxis have been taking up a large share of the conversation recently. Less so around Alphabet, more around Google. But, I mean, how much does this matter for Alphabet, success in Waymo?
Well, it's interesting. So Alphabet, call it a $2 trillion market cap. Waymo's, I think, valued about $100 billion as of late. So it's about 5% of the enterprise value. But to your point, Waymo plus cloud plus YouTube shows that there's more in the portfolio at Alphabet than just simply search, right? So things like Waymo help people get a little more comfort that it's not all about one business fading into the into the future. So success from Waymo is actually really important to kind of reaffirm the company's technology is working. They have other innovation across the enterprise, and in itself, it's nice to have, but it doesn't move the needle. It's more of a reflection of this company has a ton of assets and a ton of strengths, and Waymo is just one of them.
I know that your partner Craig Moffett covers telephone. He's got a neutral rating on the shares. But to me, it seemed like they knocked the cover off the ball today. I mean, we were only expecting them to add 300,000 wireless subscribers, and they added 400,000, going the other way of their now bigger rival Verizon. Why do you think the market reacts so poorly to, beating expectations, reaffirming your profit forecast, adding subscribers? Like, what's the problem at telephone?
Well, how has T done this year relative to Google, right? So, T is, most of Craig's stocks have been strong because they're tariff proof, right? And they're, domestically focused. I just think it could be more a broader trade of, look, we're getting through the tariff wars. The dollar is getting weaker. Maybe we want some exposure now to more global companies that have the benefit of maybe having the tariff headwinds start to dissipate. So that could be it, because they've been very strong havens the past 6 months.
Yeah, you can see that sell-off lessening a little bit right now.
True.
AT&T down about 1% as we get deeper into the trading session. Michael, it's great to get some time with you ahead of Alphabet earnings after the bell today. That is Moffett Nathanson, Senior Research Analyst Michael Nathanson. Now, coming up, another big one after the bell, Tesla. Shares poised to move 6% in either direction following earnings, according to the options market. Can it defy the recent slump in sales? We'll discuss next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks today. We're looking at a new intraday, no, not an intraday record yet. 63.23 is the level here, and I think 63.36 is the intraday record that we reached earlier this week. Still, if we close here, it'll be a closing record. NASDAQ 100 actually down on the day, off about 0.1%. Obviously, very early in the trading session. We'll look to see if these numbers change throughout the day, very likely as we expect Alphabet earnings after the bell. NVIDIA coming, gaining 1.25% right now, but it had been higher earlier, so coming down a little bit from the highs that it hit earlier in the session. That's why we see the S&P doing that as well. Texas Instruments down more than 12% after it gave a positive earnings report, but concerned investors and saying that some customers may be pulling forward in terms of their orders. You can see these meme stocks here that Katie was talking about. Google over here right now off 0.5%, and it had been gaining actually 10 days in a row, but it looks like that's reversed into the earnings report this afternoon. And then Tesla right now pretty much unchanged, but you would think there's more action in Tesla, right? You would think, Katie, that Tesla sells a lot of cars in Japan, but it doesn't.
You might think that, and we'll see if it moves after hours when we get those numbers, because the options market is suggesting a 6% move in either direction. So let's preview now with Bloomberg's Detroit bureau chief David Welch. An interesting comment from Nick Colas over at DataTrek Research saying that Tesla, more than any other large cap stock, relies on investor confidence in the company's long-term vision of the future. David, is that long-term vision enough to overwhelm what's expected to be the sharpest drop in revenues in more than a decade for Tesla?
Look, that's the big question. I think that's why you're seeing a potential 6% swing either way. You have another year where sales are going to be down. Analysts are expecting that Tesla may even revise their goal for the year downward. That's not good. So do they have enough good news on robotaxi, which, you know, that was a pretty small sample of vehicles in a small geographic area that they started with. Do they have enough good news on that to overshadow that? And then, look, there's another variable here. Does Elon Musk say anything about his budding political career and whether or not that's still going to be in the center stage for him, or if he's going to focus on Tesla? So, you know, three different things here, and I think investors will be looking for news on all of that. And you do have, you know, will they come up with an affordable EV? What's the latest on that? When is that going to be out? And do they have any sort of forecast on what the sales will look like for that vehicle?
David, I know we're focused on so many other things besides car sales since we're talking about Tesla, but just to get back to that business, I was surprised when I looked it up this morning and saw that they didn't even sell 5,000 units in Japan last year. Is this agreement with President Trump going to help any U.S. automakers? Because it looks like Jeep is the only brand that has a significant number of sales.
It's really tough to see that happening. I mean, the U.S. car companies have never really had a very good presence exporting vehicles to Japan. They don't build them there. And, so you'll still see vehicles coming in from Japan. I think the net impact of this with a 15% tariff could be a company like Toyota, which imports half the vehicles it sells here. They could end up adding more production here, which they've been doing for years anyways. But, you know, seeing General Motors exporting vehicles to Japan or Ford, they don't really make the small vehicles that, you know, in big numbers that Japanese motorists are going to want to drive around congested cities like Tokyo. It's, you know, you're not going to drive a Tahoe or a Ford F-150 in Japanese cities.
They do apparently make a couple of hundred right-hand drive Corvettes, David Welch. I was looking into it.
A couple hundred.
Few hundred very lucky Japanese.
That's not going to erase the trade deficit.
No, but still, it's awesome if you have one. David Welch there in Detroit. He's our bureau chief, covers cars for us. Coming up in the next hour, Anastasia Amoroso explains why she is bullish second half of 2025. This is Bloomberg. We are 30 minutes into the trading day and looking to make another record close. Right now, 63.20, the level on the S&P. Welcome to Open Interest. I'm Matt Miller.
And I'm Sonali Basak, and it's really interesting to see the divergence. You see the S&P 500 hanging out above that 6,300 level. However, the NASDAQ ahead of those big earnings after the bell, lower on the day.
Yeah, I think it's fascinating. You have companies coming out with better earnings than expected and holding forecasts steady, but investors selling the shares. So you have to do very well in this market.
Discerning market, and coming up, we're going to talk about how the record-breaking run in stocks is getting fresh fuel as the U.S. strikes a trade deal with Japan.
Meanwhile, Tesla prepares to report results following a turbulent quarter for the stock and its CEO, Elon Musk.
And Alphabet also in the earnings spotlight, shares nearing their longest winning streak ever ahead of those results.
Except for the fact that they have just traded down and are starting to trend lower. So maybe we won't get 11 straight days on Alphabet. We have some breaking economic news crossing the terminal right now on housing. U.S. June existing home sales fall to a 3.93 million annual pace. The estimate was for 4 million, and the prior was a little more than 4 million. So existing home sales doing a little bit worse than we had anticipated.
Yeah, and that's even as we've seen of late the 10-year yield really hang out well below that 4.5% level. A lot of people watching to see if that housing market meets a recession territory, actually, and declines enough to cool this market down. Anyways, that's the bad news. There's some other good news, isn't there? And that's in the world of AI. The Trump administration is hosting an AI summit in Washington today aimed at expanding the U.S. economy through AI development. Commerce Secretary Howard Lutnick had spoken to Bloomberg earlier about one of the bargaining chips in the trade war.
The H20 was the third best chip in the world, and now it's the fourth best. The president has decided that if things are going well with China, that they can buy them. So I think that decision's been made. We are putting on the licensing mechanism, and we are getting that going. But the president has decided that the Chinese can buy them, but that's in a balanced way with the Chinese delivering on the deal that we made with them, and they're delivering rare earths to American manufacturers.
Bloomberg Tech co-host Ed Ludlow joins us now from Washington, where he will be reporting from today's AI summit and ahead of earnings as well. What are you looking for throughout today ahead of what we'll see as really promising numbers for telling the story of how investors are going to react to AI expenditures for the remainder of the year?
Right. Well, I think that's the right thread to pull. So, at the heart of what Secretary Lutnick was talking about was not policy or regulation with regards to, guardrails around AI, but policy and regulation in how America and this country exports its technology stack. The expectation is that the president is basically going to say and explain how countries around the world can access American technology. The H20 that Lutnick referenced is, of course, NVIDIA's depressed chip. It's a chip that had the performance engineered out of it for the Chinese market. But as we now know, NVIDIA and AMD, leaders in that field, are able to export. There are still questions about codified rules for other countries, and then energy as well. Energy is going to be a really key point of discussion. And a part of the strategy that this White House is going to push forward.
Hey, in terms of Tesla, we're expecting earnings, and we're talking about high bars today with other companies. Elon Musk basically just has to tell investors that he's going to continue to focus, or maybe return his focus on that company, right?
I think that's exactly right. The consensus estimates are that revenue is going to drop by the most in about 10 years. But if you look past the core business of selling vehicles, the vision is robo-taxi. However, investors just want to hear that Musk is engaged. So the prior earnings call when he came out of Doge was, look, I'm going to reapportion my time back to Tesla. We broke this story last night that in the documents that SpaceX sent out to investors in its tender round, they've added in the risk factors section an acknowledgement that not only had Musk been involved at a deep level as a government advisor, but one of the risk factors going forward for that private company is that he may return to a role like that. And so Tesla investors feel exactly the same way. They just want to know that with all these big picture projects and 95% of the valuation based on a future where the business model is different and it is predicated on robo-taxi, that he's focused on it. And that's what they'll hope to hear from the call, irrespective of the print in the quarter gone.
All right, Ed, thanks very much for joining us. Tech co-host Ed Ludlow reporting live from Washington today, where he will be attending that summit. For more on the tech trade, we're joined by Anastasia Amoroso, Chief Investment Strategist for Private Wealth, now at Partners Group. And first off, congratulations on the new post.
Thanks so much. Great to be back with you.
Great to have you here. Tech is front and center, not only because of the earnings we're expecting after the bell, but also the majority of respondents in our MLive Pulse survey said that they expect tech to lead the charge in terms of earnings growth this season.
Yeah.
What do you expect from, the Mag 7 and co?
Right. Well, that has been the case. The communication services and infotech has actually led the S&P in terms of earnings growth. And by the way, they also lead the S&P in terms of margins and how robust the margins are. The other thing, Matt, that I found interesting is everybody worried about margin compression this quarter. And it is true for the S&P that the margins took it down a notch from 12.7% to 12.3%. But that is not the case with tech. And that is not the case so far with financial. And it's not the case with communication services. So I think those companies should continue to deliver. And of course, you know, the Mag 7 are expected to grow their earnings by 14% versus the rest of the S&P, which is about 3 or 4%. So I do still expect the tech trade will deliver.
How much do you think investors have patience around CapEx spending? We saw a lot of love for investors who were willing to watch Microsoft, Meta spend more and more. But what about now with valuations at these levels? Do they simply want them to use their capital in a different way?
I'm not so sure, because I think we're finally at this inflection point. We are starting to see some payoff on the CapEx that has been put in place. And if you think about some of the artificial intelligence tools, for example, they are getting increasingly adopted, and they are increasingly incrementally more useful to companies, and more companies actually use them. So I do think we're at this interesting stage where we start to see the payoff. Interesting, Sonali, you mentioned CapEx, because I think as a macro market, we worried about whether CapEx is going to be put on ice because of all the tariffs and all the uncertainty. And that has not fully been the case. We've actually seen CapEx investments accelerate this last quarter despite all the tariff noise that we've seen. And by the way, not to mention the tax bill that was recently passed, it is designed to incentivize CapEx investments by corporations.
I wanted to go right there. And you mentioned the earnings growth expectations. I've been playing around with the EEG function on the Bloomberg terminal, which shows earnings estimates and expectations going forward. Here you can see Q2, Q3, and Q4. And obviously we've come down substantially from the end or the beginning of this year, but we're starting to sort of turn higher as we get trade deal with Japan, after we get the big, beautiful bill, after we get more certainty on these things. Do you expect those expectations to continue heading upwards?
Or at least stay neutral. And I think there's some offsets. So first of all, let's take the tariffs as the first item. And look, 15% tariff is still potentially going to have to be absorbed either through corporate margins or through consumers' balance sheets or through consumers' wallets. So that could be an incremental negative. But then let's talk about the tax bill. And I think that's not really talked about enough, which is that is a huge incremental positive for both consumers and corporations. And Matt, the reason I say that is because there's sort of a lot of dispute on how much economic impact you're going to see from the tax bill. Some people pencil in 0.4% down. Some people pencil in 0.4% up. But what's probably not disputed is the fact that most of the U.S. consumers are going to see their after-tax incomes rise in 2026 by about 5% or more. So that is a huge positive, as far as I can tell, for the U.S. economy. And then and therefore for earnings, and back to the corporations, the fact that we now have the 21% corporate tax rate, we have 100% bonus depreciation that is made permanent, we have R&D expensing that is permanent, that is a big deal. And I think that offsets any potential headwinds from tariffs.
So you have a lot of reasons to be optimistic. Investors certainly do. You're seeing the tax bill really be mentioned from corporate America as well in earnings calls. But what is there to be nervous about? We're still right near record highs. What would throw this party off?
By the way, I'm thinking of AI because we're looking at Trump headlines and he says the U.S. is going to remove onerous AI development regulations. So longer term, if you want something to be nervous about, right?
Is AI taking
It's going to kill all of us, isn't it?
Well, let's not worry about that. But I'll give you a couple of things that we are concerned about, as investors are concerned about. First of all, near term, if I look at the market, of course, it's gone a long ways in a short period of time. And you look at multiples in public markets, they're elevated. We're finding lower multiples in private markets. So I will point that out. And you do have a slew of catalysts. You have the August 1st tariff deadline. You've got the Fed meeting. You've also got the Treasury refunding, which is also not talked about. But that's happening on Monday and Wednesday of next week. So that's near term what I worry about. Longer term, Matt Sonali and my client conversations is all about the budget deficit and the fact that it's $3.7 trillion higher projected to be over the next 10 years. Guess what potentially offsets that? Is the tariff revenue. Well, maybe growth, but also the tariff revenue. And if we do have 10 or 15% tariff that's here to stay, that's the potential for up to $3 trillion in revenues from tariffs. So concerns, but I think offsets to those as well.
A lot to keep an eye on through the end of the year. Anastasia Amoroso of Partners Group. New job. Looking forward to following you through it. And we're going to watch some more movers on our radar as well. We're looking at AT&T, Matt, down 0.6%. Promotions led to a surge in wireless subscribers last quarter, but it was not enough to wow Wall Street. This is what we're talking about that discerning investor this earnings season.
Yeah, investors expected 301,000 mobile subscriber additions. They actually added 401,000, so a big beat, but investors wanted more in terms of the outlook. Hilton lowered expectations for the year as travel demand slumps. There's been a lot of talk about European travelers not coming to the U.S. Enough, and it looks like that's playing through in terms of Hilton's earnings. The share's down 1.3%.
Certainly a sector we're watching closely because it's so tied to the consumer, and so too is Hasbro. Remember, this is a stock that's been up about 34% this year, so it's taking a decline today after still boosting its forecast, beating estimates, and there you go, that discerning shareholder once again after a stock has risen 34%.
You don't need 30 dolls. You can make do with 1 or 2 dolls.
Speak for yourself. Right? Anyways, coming up, we're going to talk more about what Anastasia was talking about here. Private equity is a hot topic, but it's turning to a controversial tactic in order to weather the IPO slump. You may have heard of it, continuation funds, and we're going to get into it with David Gross of Bain Capital next. That's next in our Wall Street Beat. This is Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. The number of companies and organizations compromised, I should say, by a security vulnerability in Microsoft's servers is increasing exponentially. The hackers breached about 400 government agencies, corporations, and other groups, according to reports. That's up from the roughly 60 based on previous estimates. As you can see, Microsoft for the past 2 days down almost 2%. Coca-Cola is launching a new product this fall. It's made with U.S. cane sugar, a type of sugar that U.S. farmers can't fully supply. The U.S. may need to import the more expensive sweetener from Mexico and Brazil. And President Trump's threat of a 50% tariff on Brazil also risks raising prices there. So maybe they'll just release a few bottles and the rest will come with whatever they normally use. Tom Hayes, the former star UBS trader who was the face of the LIBOR rigging scandal, won a bid to overturn his criminal conviction. The victory clears his name a decade after he was sent to jail. The scandal broke out when the banking community still faced public outrage after the 2008 financial crisis. Sonali?
And now we're going to go from the banking industry to the private capital world. It's time now for the Wall Street Beat. Today we're getting the view from Bain Capital about the current global macro landscape. Trade optimism is boosting public markets. Let's see if they're boosting private ones too. Joining us at the desk, David Gross, co-managing partner of Bain Capital, a firm with approximately $185 billion in assets under management. How do things change? A lot of the public markets are reacting pretty drastically to a lot of these headlines, but a lot of the volatility has not translated on the way down, has it translated on the way up for private markets?
Right. Well, I think you've seen some announcements which suggest that there are trade deals coming, and there's a balance that's being struck between some of the policies we saw in Liberation Day and ultimately things that will be good for economic growth. I do think it's important to stay one level above from the daily announcements because there are so many of them. But directionally, I think the economy is doing fairly well. I'd say better than we would expected coming into this year. The markets have absorbed the trade discussions and focused on pretty good labor numbers, pretty good overall numbers in the consumer sector, and now you have some government stimulus that's on the way. So I think there's some optimism, within a very multifaceted policy regime that's being developed.
Usually we ask this question for public market investors, but I've heard it now being discussed as a worry for private market investors, the dollar decline that we've seen over the past year. How much do you worry about it and have to start factoring in the threats to the dollar long term when you're making investment decisions on what to buy? Things that might be sensitive to it because of their imports or exports or for any other reason.
Sure. It's one of the factors you look at for sure. And recall, the dollar's been quite strong now and on a continuous linear upswing for many years. So in a lot of businesses that we own, we've factored in scenarios for the dollar to kind of revert to something that's more kind of long term. And we're a global operator of businesses, so we have businesses that have exposures across lots of different currencies. And so it's not just the dollar, but it's the dollar relative to what? relative to the yen, relative to the euro. What does that mean for underlying long-term, economic growth? And I still think you've got some positives in the U.S. kind of side of the equation with strong productivity growth, strong long-term prospects that will potentially cause some dollar weakening, but within a relatively narrow band.
So the trade deals make things maybe better than expected, certainly better than expected on April 3rd. But I imagine you still have to do some shifting in terms of global supply chains. How significant has that been?
It's true, and again, I remind everyone that this is a trend that's been occurring now for 5 or 10 years. We've seen, in many ways, the breakdown of free and unfettered global trade for a lot of years, and so we've been counseling our businesses to come up with backup plans, alternatives for supply chain, in many cases to find production opportunities in the United States, to the extent it's a U.S. Kind of end market. And we've accelerated that with our business, obviously post Liberation Day, but it's really putting in action kind of the plan B that was there. But a lot of businesses do face significant uncertainty about where tariffs will land. We don't know if the effective tariff rate will be net 7, 10, or 15, but we do know they'll be substantially higher than the past. And so there's kind of a hedge that I think all business planners have to put into their models right now.
I don't know, you're probably going to go there, Sonali, but I'm always interested in how public investors can get a hold of private assets. We already see big retirement firms being able to do this for teachers and cops, but for me and Sonali, right, it's more difficult.
And a lot of people are waiting for that President Trump executive order for 401ks.
That's exactly where I was going, exactly my point. What do you think that's going to do for the business?
Well, listen, it's part of a longer-term trend to open up called alternative investments to a broader set of investors. And I think it is positive in the sense that groups that have not been able to access it due to accredited investor rules or due to just a lack of being able to get into these funds now have opportunities to balance their portfolios, just like pension funds and sovereign wealth funds have in the past. And so I think it's a good long-term secular trend that you're going to see along with the penetration of alternative investments. But there are some aspects of it that we're going to have to be cautious around. It's a different investor base, not as used to the illiquidity that is there. Could be potentially more volatile in downturns. And so there's some potential negatives that the industry really has to build into their thinking around how aggressively you pursue this class.
Speaking of liquidity, I want to point out a story that was this morning just in the Financial Times, the continuation fund model that has been pulling so much money, $41 billion worth of investments in the first 6 months of this year alone were gone to continuation funds. A record use of what's been a controversial tactic to cash out by selling assets to themselves. Or to other funds. Right, I mean, this has become crazy at best a little bit, right? I mean, I don't really have another word for it.
To me, you guys, you cover this industry and you're in it. So for you guys, this is pretty normal. For an outsider, for a layman like me, it's hilarious.
Well, let me give you the other side of the equation here, which is a structure that gives you the opportunity to hold on to really great businesses in a long-term sense is really actually a new tool for an idea that's been around for a long time in private equity. But like with any financial tool, it can be used well and misused. And the use well case is we're going to keep holding a business and invest, but also give our limited partners the opportunity to monetize if they'd like to, or to reinvest if they'd like to, and to bring in new investors, secondary funds, who are very sophisticated and will make a decision whether they would like to do it. It's misused if it's not a very good business or it's a business that's hard to sell and you're not giving that choice to investors. And I think some have gone down route A and some have gone down route B. And I think a lot of articles about the route B, but I do think this is like anything else, it's innovation. And innovation comes with some initial fits and starts to find out, how do we deploy this to the mutual benefit of all the parties involved.
And it could certainly be a double-edged sword. We'll be watching it through. I've heard this morning that like 15% of deals that we're seeing right now in this space compared to like 5 to 8% typically are being done through these funds. So
yeah, but to your point, they're sophisticated.
Well, 0 to 5.
They're sophisticated investors at the same time, right? So they know what they're buying. It's not like
presumably.
Yeah.
But sometimes the tide does go out. Anyways, Bain Capital co-managing partner David Grossky, thank you so much for walking us through all the complexity. And coming up later this hour, we're going to be joined by tech investor Sarah Kunst to join the show to discuss her current strategy ahead of those magnificent 7 earnings kicking off. This is Bloomberg Open Interest. Let's get a check on these markets. A mixed trade. The S&P 500 still well above 6,300. Matt, earlier this week you did see it fluctuate below. We'll see if that holds. It's up about 0.3%. The NASDAQ 100, though, down about 0.1%, heading into those big tech earnings later this afternoon. The 10-year yield below 4.4%. Coming up, we're going to talk about Google's Fusion future. Stick with us. Now, investors are going to want a clear picture of Alphabet's future when they report earnings after the bell, and Commonwealth Fusion Systems will be helping to power it. Google announcing 2 investments into the fusion power company. Commonwealth's first planned commercial plant is expected to deliver clean energy in about 5 years. Joining us now with more, the company's CEO, Bob Mumgaard. Bob, help explain how fusion might help in terms of delivering more energy to power the AI revolution, if you will, and the cost at which that might be done.
Right. So fusion energy is an energy source that we haven't yet harnessed yet. It's sort of like the last remaining energy source. It's the source of energy that's inside all of the stars. And the great thing about that source of energy is it's effectively unlimited. And you could build it on an existing site that already had a power plant with no emissions. And you wouldn't have fuel constraints. You could basically build machines that made energy. This has been a long time dream, but we're now in a race to develop fusion energy, very similar to the AI race, with different companies developing technologies. And we're the leader of that, the largest of the companies. But this could be a source of energy that would fit very well with what we need to power the data centers. It's energy source that we make a lot of energy on a small plot of land that can run 24 hours a day, independent of the sun or wind. So that's why there's a lot of interest in this energy source from the people that are also interested in AI.
Well, but why haven't we got a ton of fusion plants already? Then I'm no nuclear physicist, but fusion is pushing atoms together to create one, whereas fission is splitting them. Why hasn't it been widely adopted?
Right. So you got it exactly right. In fission, nuclear power today, we take atoms, the heaviest ones, and we split them, uranium and plutonium. And that, of course, it works. We've demonstrated it since the 50s, but it has some ramifications. It can go too quickly. It can run away. It's hard to shut off. It has the same stuff that's in a bomb. So those are some of the issues that we have to handle in that technology. Fusion, it's a little bit harder because you actually have to combine these atoms together in very hot, intense regimes. And so you need to figure out how to get things to like 100 million degrees, like the center of the sun. And the world's been working on that, and it's an innovation story. It's been faster than Moore's Law. And we're just getting to the point where we can build machines that can create the right conditions, but we haven't yet got to the point where we do that in any sort of commercial context. But the machine we're building in Massachusetts is anticipated to be the first one to be able to do that.
With this entire discussion around a shortage of rare earths, minerals, magnets in particular, how does that change the calculus, especially with a global trade war going on? How does that change the calculus on how quickly this could be done?
With fusion, you're not using a lot of stuff to make a whole lot of energy. And so the amount of stuff you need to build a plant is much, much less than, say, the rare earths you would need to build a wind farm or to a solar farm. And so you're taking the rare earths question down basically a factor of 10 in terms of how much you need to make energy. So that's really good. But what we do have to do is manufacture things. You have to turn it into stuff that you can build repetitively at scale. And so there's supply chain implications on being able to make things, but not in the atoms that are in the ground. That fits better with, say, how we do things in the United States than if we were, being a commodity.
So how long until you're going to be able to make a lot of power with very little consistently and possibly in more places than just MIT?
Right. So the plant right now that's nearing completion, it's about 65% complete. in Massachusetts is a prototype. It will demonstrate that you can make more power out than in from the reaction in a commercially relevant way, but it won't actually sell power. That first power plant to sell power is the one that we announced with Google in Virginia. That's in partnership with Dominion, the large utility in that region, and Google is committed to take about half the power. We think we'll start building that in a few years, like 2027, 2028, and that would put it online in the early 2030s. So that might feel like a long way away for some people listening to the show, but that's drastically faster than we thought this technology could do even just 5 years ago. We've shrunken a multi-decadal timescale into less than a decade.
To what extent is Google's investment an endorsement of the technology, and do you see other similar deals being struck for you anytime soon?
So with the need for energy from hyperscalers, they are fundamentally techno-optimists. They believe in a future that is abundant and the technology can be used to solve problems and enable new things. So having that involved with fusion is a really good match. And that's a big signal that fusion's wanted, it's desired, and frankly, it's doable when you have large investments and commitments by large companies. So that's going to lift fusion overall. And importantly, Google invested in CFS, the company, the first buying the power from the plant in Virginia, but also a demand signal that they want more power from more plants. And so with that, we can now go to suppliers and the government and say, look, this is an industry that's accelerating. The flywheel is getting faster. More people are helping push that flywheel. And some of those people are the largest tech companies in the world. And it's not just Google. Microsoft has done a fusion deal as well. We see interest from other parts of the AI supply chain. So this is a growing area.
All right, Bob, it is fascinating stuff. Really hope we can get you back on here as you make progress. Bob Mumgaard there of Commonwealth Fusion talking to us about being able to create vast amounts of cheap energy for AI.
Let's get a check on these markets as well, because AI is not powering today's market for the moment, at least not Alphabet before earnings today. And you are seeing that reflected in the NASDAQ 100 being a little lower, about 0.2%. You are seeing the S&P 500 still higher, about 0.2%, slightly defensive, I would say, relative to the exuberance we've seen the last couple of days. 10-year yield hanging out around 4.37. It's pretty calm there. It stayed calm while you were gone, Matt. It's still calm now that you're back, but not as calm. Meme stock mania, that's also back. Yesterday it was Kohl's, which spiked over 100% at one point, and then Open Door this morning. We have GoPro, Krispy Kreme, and Wendy's all spiking pre-market and into the market. Let's take a look at all the action with Bloomberg Equities reporter Carmen Reinecke. What makes a good meme stock, right? I mean, what does it take to capture the attention of the horde?
Well, I think there are a lot of things. What we usually see is that there's movement in the stock price that's really divorced from fundamentals. I think that brand names make great meme stocks. It's things that people know that they've heard of. One thing that we're also watching is that retail traders really love to go after things with high short interest. So they're looking at where people are betting, are placing contrarian bets and betting for the stock price to go down and saying, all right, let's buy it, let's drive it up. This is obviously very similar to what we saw in the 2021 sort of COVID pandemic meme stock frenzy with GameStop and AMC. So we're seeing some very similar action here today with shares of Krispy Kreme, Wendy's, GoPro, all names that you've definitely heard of, but maybe aren't the biggest stocks that you're putting in your portfolio.
But the thing is, we had in 2021 the stimmies, right? You had retail traders were sitting on these checks.
You could argue that you're getting the stimmy now.
Well, not in actual cash in your bank account, right? I mean, maybe if you're going to count on after-tax gains at the end of the year, but what is it? What's powering this?
Yeah, I think you bring up a really interesting point, which is that we have some very big similarities to 2021, but these are the key differences. We don't have stimulus checks coming in. We also don't have zero interest rates, which was sort of something that people said was driving that mania then. I think what we have now is just a lot of euphoria in the market. We have a lot of exuberance. The S&P is at all-time highs, and retail traders are really looking to get into that action. Fear of missing out is huge, and I think people are really saying, all right, where are places that I can put my money if I'm not going to buy NVIDIA, or I'm not going to buy, the stock that's had a huge run up, or maybe that I've missed out on.
Speaking of fear of missing out, I did contact Citadel Securities yesterday because they do work with so many retail traders, and And their most recent note says this retail demand is an anti-momentum, high realized volatility, high market beta, and market consensus shorted equities. To your point on the short interest, these were not on their bingo cards either. And so when you think about what people are buying here, the short interest, but also could this have even happened if we weren't at all-time highs? It feels like these retail traders have some dry powder after betting on things that have run up since April.
That's a great point.
You know, I think that rotation is probably there. It makes a lot of sense, especially if we think about what retail also likes, which is tech, which has done really well. It's had a huge rebound from April. It's really powered us back to record highs. So I think now, you know, maybe people are having a little bit of fun. They are looking for that beta and saying, you know, why not?
All right. Carmen, great having you on this story, and it'll be fascinating to watch if it continues. Carmen Reinecke there from our equities team. Coming up, Sarah Kunst joins us of Cleo Capital. She'll explain why she's bullish Alphabet and bearish on Tesla, which takes some real courage.
Sure does. Speaking of short interest.
This is Open Interest. All right, investors gearing up for the high-stakes Mag 7 earnings season, and kicking it off tonight, Tesla and Alphabet both report after the closing bell. Joining us now is Sarah Kunst, founder and managing director of Cleo Capital, a venture capital firm, and she's got a view on these stocks that go two views, I guess, in different directions. Sarah, let me first ask you about Alphabet. Google, obviously a much bigger stock, and it'll be one that's more closely watched in terms of the trends that it lays out for the rest of the industry. What do you expect?
I like Alphabet, and I think it doesn't always get its fair shake. I don't really understand it. They are doing very well at every single trend that the rest of the market is chasing right now, except maybe stable coins, which I don't think they're in, but they're doing incredibly well in AI. I think anybody who doesn't see them as a huge leader in that space just does not understand sort of the genesis of the technology. And so, you know, I am very, very bullish on this name. And I think that the street kind of keeps overlooking them. And so if there's a stumble here, if there's something they don't like in the numbers and there's a dip, I think it's probably a pretty interesting buying opportunity.
What's going to be the biggest factor driving their valuation higher, especially as you say, it's kind of hard to see the street right now at the very moment catching on to that love?
You know, I think that what people are waiting for is a piece of storytelling that I don't think Satya is the best at, which is for him to lay out what the world looks like in 5 years when Google is getting the majority of their ad revenue through AI sort of enabled or enhanced means. I think the big concern right now is that there's not enough awareness at Google that, hey, your business model, you do all these cool things, you literally have, you know, self-driving cars that work, but the reality is that your money still comes from those blue links that people are clicking when they go to google.com. And so how are you going to replace that revenue? I doubt it's going to be particularly hard, but I think that the leadership needs to start really threading that needle and making it clear.
Is Google AI or Gemini something that you would use personally rather than ChatGPT?
I don't use ChatGPT. I use Google Workspace for my work. And so, you know, I figure since they already have my emails and everything else, my documents, keeping that data sort of all on one platform makes more sense. And then I also think that ChatGPT, we've seen repeatedly some of the all AI hallucinates. I think with ChatGPT, there's a question of, are they incentivizing sort of longer time on site by kind of glazing you, as it's called, and telling you things that necessarily aren't accurate. And I don't need an AI to tell me that, you know, I've discovered a groundbreaking new physics theorem and that I'm the creator of the universe. And I think that Gemini's a little bit better about not doing that.
Sarah, I do want to ask you about Tesla as well. One thing that our colleagues here have reported on is the warning that was tucked into documents for investors who might be investing in SpaceX at pretty astronomical levels, right? And so the warning is such that Elon Musk may serve in politics again, essentially. Why is that not a bigger disclaimer when it comes to Tesla, or do you think that's already reflected in the price?
I think it's already reflected in the price. I think that there are sort of with Tesla, everything's priced in. A hobby is to go onto some of the Tesla subreddits. And, you know, the joke always is no matter how bad the news that the stock is going to go up. And it tends to, particularly in the overnight. And so I guess there are some really passionate overnight traders of that name. And so, you know, Tesla's proven that it is absolutely immune to every sort of sane metric of how companies are valued. You know, we have some huge things coming up with Tesla in terms of those regulatory credits that were the only thing keeping them profitable in Q1 that are going to go away with the EV mandate cut from with the big beautiful bill. And so, you know, will some of that reality start to set in? The stock is so overvalued compared to its peers that I don't see a soft landing or a slow sort of realization of maybe it's a little too much. I think it's going to keep going up and to the right until it falls like a lead balloon. And I have no idea when that is.
I mean, Sarah, people have been bearish on this stock ever since they first started selling shares. I remember Corey Johnson wanted to go short back when I had a full head of hair. Are you just sort of watching this with popcorn, or are you actively engaging in, you know, short selling it or selling puts because it's still worth over $1 trillion?
I think probably the smartest, the easiest question to ask an investor to see if they're smart is, you know, are you a Tesla bull? And if they say no, I'm a huge bear, say, are you shorting Tesla? Because shorting Tesla is historically the easiest and fastest way to lose your shirt on the street. I am absolutely not going against that sort of fanatical fan base. That being said, my popcorn is out. I am curious to see how his diner does. I am curious to see how his new political party that he can't be president of goes. I think all of this is incredibly interesting, and none of it seems to impact the fundamentals of the company.
Sarah, we got to leave it there. We're looking forward to seeing your reactions after the results all come out. That is Cleo Capital Managing Director and Founder Sarah Kunst. Now, coming up, the U.S. strikes a trade deal with Japan, and who's going to be next? We're going to get the latest from Washington next. This is Bloomberg Open Interest.
I'm not going to name names, but they're good candidates. As I said, on the board, there's several female regional bank presidents, and then there are some fantastic women outside the Fed.
And that was Treasury Secretary Scott Bessent speaking earlier on Bloomberg, saying there are a lot of strong candidates that could succeed Fed Chair Jerome Powell. There's no rush, though, to identify a successor, although we know that there is a date on the calendar. And House Speaker Mike Johnson is also weighing in on Powell's future. In an interview with Bloomberg reporters and editors this morning, Speaker Johnson said he is disenchanted with Powell. Our Washington correspondent Tyler Kendall joins us now for the latest state of play. Trade, monetary policy. There's a lot to talk about. I do want to start with trade because that's the optimism that's helping the street out a little bit here. We know that the Treasury Secretary has spent a lot of time with the relationship with Japan. EU has been tenuous throughout the entire process. Where are the greatest signs of optimism and the greatest worries as he forges towards August 1st?
Well, Sonali, there's a lot to dig in here, but it did appear that administration officials this morning, including Howard Lutnick, the Commerce Secretary, and also the Treasury Secretary, Scott Bessent, who you just played that clip from, did appear to signal that perhaps the Japan deal could be used as some sort of framework moving forward for those other trading partners that have yet to clinch a deal. And it comes about this idea, what officials are sort of dubbing innovative financing when it came to that Japan deal, as you've been covering. The administration says that there will be a $550 billion fund. And that's ultimately what got that negotiation over the finish line. This idea that President Trump is going to be able to steer investments from this fund, decide which projects the money goes towards, and then the U.S. will get 90% of the profits while Japan gets the other 10%. Now, we heard from Scott Bessent this morning when asked by our Anne-Marie Herdern whether or not the European Union, for example, has brought something innovative, in his words, to the table, such as this financing. He said, no, not yet. So that's really what we're starting to look for here as we wait for some other trade announcements to come forth, because as you well know, Friday marks 1 week until August 1st. And at this moment, we haven't gotten indications from the White House that they're going to let up on that deadline.
In terms of the Fed, Tyler, you know, the president and his allies often talk about the money that we're losing with rates at this level. Do they assume that an appointee of the Trump administration lowering rates will automatically bring down the 10-year yield? Because the investors that Sonali's been talking to are saying it could steepen the curve if we put a yes man in the top seat at the Fed.
Right. Well, we've actually been posing this exact question to administration officials on balance of power, such as senior counselor to the Treasury Secretary Joe Livornia, who says that he doesn't think that this is going to risk any sort of market credibility because they feel so confident in the data that they are heading towards a lower rate environment. But that is something that is on the table here as we do look at the potential options. And you mentioned at the top there that House Speaker Mike Johnson joined us in our D.C. bureau today. And I was trying to press him on some of these questions when it does come to how the administration is pulling on allies to keep up the pressure on the Fed chair Jerome Powell. Maybe not so much that this is a question about a firing, but perhaps pressure when it comes to a resignation. I asked the speaker directly whether or not he has been in touch with the administration about a potential congressional investigation, because that would potentially lay the groundwork here when we're talking about that high legal bar. He said that it hasn't reached his level of leadership yet, but that he is confident that the House Oversight Committee will look into it if they do deem it necessary. So those are some of the themes, as it really does appear that the administration is not going to let up this pressure. But as you heard from the Treasury Secretary, he says they're not in a rush for a replacement ahead of that May 2026 date for Powell to be done with his chairmanship.
All right, Tyler, thanks very much. Tyler Kendall there reporting live out of Washington, D.C. We'll continue to bring you any developments as we get them. Coming tomorrow, we're going to talk Tesla with William Blair analyst Jed Dorsheimer, and we're going to hear from the CEO of the NASDAQ. Adina Friedman joins us, as well as John Stoltzfus. He has the highest target on the street, Sonali, and so far he's been looking very smart.
Everybody loves a little optimism. Perhaps they'll bring it to us tomorrow. Today, you're not seeing it that much in the markets, but the day is young. Stick with us through the close throughout this busy trading day. This, though, was Bloomberg Open Interest.